Welcome back to The Explainer. Today, we're diving into a fascinating corporate paradox involving Linde plc, a situation that played out right in front of Wall Street on July 31st, 2026. Now, if you follow industrial gases and engineering, you already know Linde is an absolute titan in the space. They dropped their Q2 2026 earnings report, and man, on paper, it looked like a total slam dunk. We're talking record growth, massive strategic investments, the whole 9 yards. But the market's reaction? Well, that told a completely different story. So we're going to dig into the data directly from their report and analyst notes to figure out exactly what happened and what you really need to take away from it.
Okay, let's start with this top-line explosion. When Linde opened their books for Q2, they announced a staggering $9.3 billion in sales. That's up 9% year over year. Underlying sales grew 4%, split perfectly down the middle between 2% higher pricing and 2% volume growth. And the bottom line? It looked just as healthy. They reported a record adjusted earnings per share of $4.50. That's a 10% jump from the previous year, handily beating analyst estimates. Net income climbed to nearly $1.93 billion, and operating cash flow was so strong, they actually returned $1.59 billion directly to shareholders through dividends and share repurchases. On the surface, this is exactly the kind of financial flex you want to see from a market leader, right?
But here is where the story gets incredibly interesting. Record sales, record EPS, billions returned to shareholders. So why on earth, when the opening bell rang, did Linde's stock take a nearly 6% dive? I mean, for a mature industrial compounder like Linde, a 6% drop in a single session is huge. The market clearly saw something in the numbers that spooked them, something lurking right beneath those flashy top-line records. So the real question is, what exactly triggered that massive sell-off?
Section 1. Unpacking the margin squeeze.
To figure out what spooked Wall Street, we gotta play detective for a minute. Top-line revenue is great, sure, but we all know Wall Street is notoriously unforgiving when it comes to profitability ratios. And for Linde, that growth story just wasn't translating perfectly down to the profit margins. There's a really stark contrast in end market performance here. Growth was strong basically across the board, but we have to talk about that massive 18% jump in the electronics sector. Absolutely their star performing. Geographically, the Asia-Pacific region led the charge with a 13% spike in sales, and that was driven heavily by electronics demand and some new project startups. Meanwhile, more stable sectors like food and beverage grew at a modest but steady 3%. But here is the catch. Selling more doesn't always mean you're making the same percentage of profit on every single dollar. That robust sales growth in APAC, it just didn't align with the expected bottom-line profitability. And that brings us to the primary culprit for the stock drop. Linde's adjusted operating margin slipped down to 29.5%. Now, to put that into perspective, it was hovering at about 30.1% a year earlier. That is a drop of 60 basis points. And even if you strip out the effects of passing fluctuating costs onto customers, the decline was still 30 basis points. Look, in the high-stakes world of industrial gases, a shrinking margin, even a slight one, while your sales are booming, is a glaring red flag for analysts. Basically, it means it's costing Linde more money to generate that record revenue. So what's actually eating into these margins? The data points us to three main headwinds. First and foremost, we have Lincare, their U.S. home care business. Lincare has just been getting battered by persistent cost inflation mixed with some unfavorable reimbursement changes. Actually, if you exclude Lincare, Linde's margin in the Americas would have improved by 20 basis points. Second, we have that booming Asia-Pacific growth we just talked about. While APAC sales were up 13%, the region actually saw a margin decline of 120 basis points. Why? Well, a lot of those sales were driven by a shift toward lower margin equipment and hard goods rather than their high margin industrial gases. And finally, they're dealing with helium supply dislocation costs. Those are really squeezing near-term profitability, even with firmer pricing in the overall market. But management isn't just sitting on their hands here. They are taking aggressive action. CEO Sanjeev Lamba actually addressed this head-on during the earnings call, and I think his exact phrasing perfectly illustrates their mindset. He stated that they are, quote, evaluating the strategic fit of Lincare in part and as a whole. Now, in corporate speak, that is a massive neon sign hinting at a potential strategic sale or spin-off. Analysts immediately read this as a willingness to amputate a struggling appendage to protect the healthy margins of the core business. Section 2. The billion-dollar chip bet. Okay, let's shift gears from margins to the future. Because while the market was obsessing over a fractional margin drop, Linde was quietly locking in the future of the entire company. The sheer scale of these new agreements is absolutely massive.
Literally on the exact same day they reported earnings, Linde announced monumental deals to supply ultra-high purity industrial gases to a major semiconductor manufacturer. In Phoenix, Arizona, they're dropping a cool $1 billion to build 2 new Spectra air separation units for 2 new fab facilities. This is literally one of Linde's largest single customer electronics investments in their global history. Simultaneously, over in Taiwan, their joint venture Linde is investing another $800 million to supply gases for advanced packaging and manufacturing sites for that exact same customer. They're cementing themselves right into the foundational infrastructure of the next generation of microchips. And this completely illustrates the payoff of those bets. The project backlog is absolutely exploding. Because of these huge semiconductor wins, Linde's sale of gas backlog hit an absolute record of $8.1 billion. That is up a full $1 billion from just 3 months prior. When you add in their engineering and other projects, the total backlog sits at a staggering $11 billion. The big takeaway here, Linde has guaranteed, locked-in revenue stretching years into the future. In fact, management plans to start over 20 new projects worth $1.3 billion over the remainder of 2026 alone.
Section 3. Green Power, Real Profits. Let's move over to another massive pillar of their future strategy, which is sustainability. And I really want you to view this not just as an environmental win, but as a heavily scaled strategic business move that directly impacts their operational resilience. Just a few days before their earnings, they announced a massive expansion of their renewable footprint by signing 6 new power purchase agreements, or PPAs. These agreements are going to pump approximately 0.63 terawatt-hours of wind and solar energy into their operations every single year. And this is not localized. This is a global push, spanning facilities in Spain, Greece, South Africa, and India. It's a highly calculated move to hit their aggressive goal of reducing absolute emissions 35% by 2035. And get this, since 2021, they've actually increased their active renewable power purchasing by 2.7 times.
And that massive scale-up leads us right to this incredibly impressive number, 50%. Thanks to these new agreements, low-carbon power now accounts for roughly half of Linde's entire global electricity consumption. Think about that for a second. For an industrial manufacturing company that relies on incredibly energy-intensive air separation units, powering half of your global footprint with low-carbon energy is a monumental logistical and strategic achievement. It heavily insulates them from fossil fuel price shocks, and it perfectly positions them for a greening global economy. And this brings us to what Linde's Vice President of Sustainability, Aaron Catapano, highlighted as their ultimate sustainability flex. The industrial gases Linde provides, things like hydrogen for clean fuels or oxygen for more efficient combustion, these actively help their clients lower their own footprints. In 2025, Linde's products help their customers avoid 98 million metric tons of CO2. That is more than twice the total carbon emissions produced by Linde's own global operations. It's a net positive environmental impact that serves as a massive, massive selling point for increasingly eco-conscious corporate clients.
Section 4. Outlook and Final Verdict. So bringing all these pieces together, how does management view the road ahead, and what's the final verdict from Wall Street? Well, if we look at the financial guidance provided by Linde, we find the second reason the stock took a hit. For Q3 of 2026, they project an adjusted EPS of $4.45 to $4.55. That's solid, right? It represents 6 to 8% growth. But the full year 2026 EPS guidance tells a slightly different story. Linde is projecting $17.70 to $17.90. The midpoint of that is $17.80. The analyst consensus? That was sitting at $17.93. Look, in a market price for perfection, falling 13 cents short on a full-year midpoint projection, combined with those Lincare margin issues we talked about earlier, well, that gave short-term traders all the excuse they needed to pull back.
Yet, despite all that short-term volatility, the long-term outlook from the analysts covering the stock remains overwhelmingly bullish. The average price target among 27 analysts polled is $546.84, with a consensus buy rating. Firms like CICC are maintaining an outperform rating with a target of $550, and Sanford C. Bernstein actually raised their target to $564. Add to that the fact that Linde's board just declared a very healthy quarterly dividend of $1.60 per share, and you start to see why the big institutional money isn't panicking here. Which brings us to this closing thought from CEO Sanjeev Lamba. He stated, quote, "Regardless of the economic climate, I'm confident the Linde team will continue to secure high-quality future growth projects while delivering long-term shareholder value." And you know, that really is the core narrative of Linde. They're a high-quality industrial compounder. Yes, they absolutely have to navigate a complex macroeconomic climate. They have to fix that margin drive at Lincare. But the fundamental machine, securing massive, long-term contracts in high-growth sectors like electronics, that machine remains completely intact. So I'm going to leave you with this final question to chew on. We've seen all the data. We know the 6% stock drop was fueled by a 60 basis point margin dip and a very slight full-year guidance miss. But we also know they're sitting on a historic record $8.1 billion gas backlog, and they're actively hardwiring themselves into the global semiconductor supply chain with billions in new investments. So is the market's reaction a valid concern over profitability, or is this short-term margin dip actually a long-term opportunity for the focused investor? Well, that's for you to decide. Thanks so much for joining me on this explainer, and as always, keep learning.